Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. As you can see from the graph, the Australian dollar experienced volatility last week, retreating from the 60-day simple moving average around 66 cents and plummeted now to the key level, which is seen at 64.80. The recent decision by the Fed to keep rates unchanged, along with the indication of potential rate cuts later in the year if inflation stabilises, has alleviated traders' concerns. In Australia, last week's data revealed a stronger than expected monthly report. The unemployment rate dropped by 3.7 from the previous month of 4.1%. Additionally, employment changed and surpassed expectations, showing a gain of 116,500 compared to the forecast around 39,700. Looking ahead to this week in Australia, we're anticipating the inflation report, which is the CPI year on year, while later we will be focusing on the Fed's preferred inflation metric, the Personal Consumption Expenditures Price Index, or the PCE. Market participants will closely watch these reports for insights in inflation trends and potential implications for the monetary policy decision. So as the decline continues, I mentioned the support at 64.80 may actually draw a bullish response and see a rebound to that top side of the range, which is slightly lower now, where the 60-day moving average is around 65.80 to 66 cents, and reassess from there. Turning to the euro, the market fell for the second consecutive day and is now pressuring the bottom range of 107.70. As the dollar index, which measures the greenback strength against a basket of 6 major currencies, surged further and closed at 104.40 in New York. Beside the PCE price index that's due to release on Friday, markets will also be keeping an eye on the US GDP figures. In the event we do see a break of 107.70, this would see further stop losses, as it does go back towards the beginning of February and may fall towards 107.1025 before seeing any initial bullish return in the markets. If we do see a response here, then a bounce would look towards 109.05 to 109.6065, and the cap still seen around 110 figure 15. After numerous attempts at the top side level around 151.75.80, we should still exercise caution near this level, as it is seen as the Bank of Japan's intervention level, and if so, could see the market plummet all the way back towards a base around 149.80.85 and reassess from there, as we could see further losses. Nevertheless, still play caution towards this top side in case high volatility does return, and therefore traders should continue to reevaluate their positions at key levels and adapt their strategies accordingly to their risk management. A weaker play in sterling now views further losses that could see a move towards 125.45, but we're getting a little bit to the oversold zone and therefore could see a bounce soon and look towards the top side around 126.85 to 127.45. Gold also weaker since that spinning top and now poses a threat to the downside to 2,140.46, which is where I view the base, or the temporary base in the meantime. A bounce from there could see a move back towards that level of 2,200, but this spinning top is a bit concerning, so traders should continue to expect high volatility and adjust their positions according to their risk management. Wrapping up with oil, well, after that topside rejection at $83, we continue to see some weakness that could see a lead on towards the region of 78.70.80, but from there may see a bounce. So we should not rule out a bullish return and maybe see a re-challenge to that topside key level of $83 a barrel. Well, that's a wrap. Thank you for joining me, and as always, look out for the intraday report, and I hope you enjoy the great start to the new week.